I literally used to obsess over the 21-year-old that became a millionaire with stocks, doing some crazy strategy, but well, I'm 33, so that ship has sailed. But despite this, don't you find it ridiculous that some random person that doesn't seem like they even have financial knowledge can make like $1 million with a stock like GameStop? And meanwhile, you're just sitting there, you've been prudent, you've been trying your best, but you're somehow still in the red or you're not making that much money. Well, I've been investing for the last 15 years, and over that decade and a half, I've had my fair share of envy. I've seen investors come and go. I've been a part of the emotional roller coaster of meme stocks, which I definitely regret. And so here are actually 4 truths that I've come to believe about other people's investments and why they seem like they're doing so much better than you. And so we're going to go over really 4 reasons, assuming it's not true, that they're not doing well, and then 4 reasons assuming they're actually doing well in their investments. So it might be prudent to identify that if you go and look online at all of these gurus about investing, me included, I guess, there's really only 2 possible scenarios. The first scenario is that they actually are doing well with their investments. The second scenario is that they're just feeding you lies. And so really, the first reason why they might seem like they're doing better than you is just because they're lying about it. They attribute all the good news to themselves, and all the bad news is because of the markets or the economy's bad or the president's changed. They just won't tell you about their losses. Now, I don't blame them, right? Because it's shameful to tell people about your losses in investing, and especially if you have an investment channel. But there's so much more transparency associated with that. I get that myself as well, because a few years ago, during the height of the pandemic, Alibaba, the stock, kind of Chinese Amazon, fell from over $300 per share to $120 per share. And I bet the farm on that stock. I thought I was going to make so much money that it was clearly undervalued, which I still think it is. But then over the next 2 years after that, the stock continued to decline, and at one point it was sitting at $58. I kid you not, I was $50,000 in the red. And that just kind of tells you about how much money I put in, right? And the fact that I'm telling you about this right now isn't even that, oh yeah, I'm going to tell you about my losses, I'm going to be totally transparent. I feel like, and this is something that I'm working on myself, is right now I'm telling you about this because the stock is at 140 and I made 20 grand on it and I sold a huge part of it. And so I'm not as committed or invested in it doing well anymore. I don't feel as shameful about the losses anymore. But you know, like from this moment forward, if like talking to you right now makes me feel like, you know what, like I should be transparent. Like what is there in there but a lesson, right? Everything's a lesson. So this is my flag. I'm staking it in the ground. In the future, I'm just going to be fully transparent with all my gains and all my losses. Now, thankfully, right now, because of Alibaba, everything I have is a gain. And I'm not invested in that much stuff. Aside from Alibaba, I own Berkshire Hathaway, and then everything else is just ETFs. We can do a deep dive into my portfolio in the future. The second reason is, well, you might be biased. So if you're like paying mad attention to how other people are making money in the stock market, chances are you're not making money in the stock market. And I know from experience. So you're paying a lot of attention to how other people are making lots of money and why you're not. And you feel like they have some kind of secret sauce, some kind of method. In reality, though, you're really just focusing on things that confirm your own worldview. And right now, your worldview is you could be making so much more money, but you're not, so there's something missing, right? And enter course, right? Enter coaching. Nothing bad with a course or coaching, but it's just that so many people become misinformed by the information that's out there. And they end up building this distorted version of reality that does not help them build wealth in any way, when you can really use common sense to figure out a lot of the things that allow you to make money in investing. So the third reason why everyone seems to be better at making money in the markets than you is, well, the contrast effect. Do you ever compare yourself to people that are not as good as you? Probably not as often as comparing yourself to people that are much better than you. You always compare up. People follow people that they aspire to be like. For example, Ryan Reynolds has so many followers because a lot of people aspire to be like Ryan Reynolds. Maybe not exactly like Ryan Reynolds, but at least they find one aspect of him attractive or aspirational. And so you feel this way because you're ignoring the fact that you're probably better off than most of the world. The fact that you can be in the markets, the fact that you're sitting here watching me right now means that you already have something to be grateful for. And our emotional state will determine our decisions, because ultimately investing is a rational person's game. And rational people understand the irrationality, if that's even a word, of other people. And that's really how they make money. I used to think that I had to figure out the intrinsic value of different companies and do fundamental analysis. But when I was doing teachers college, I have a degree in business education, by the way. One of the guys that I was talking to used to be a certified financial analyst. And I was like, hey, you've been doing this for a long time. So like, how do people actually make money in the stock market? And he told me, a lot of people think that it's about fundamental analysis, and to an extent it is, but if you want to make money, you have to understand people and people's behaviors in the markets and how they react to news and how they always overcorrect in both directions. And I didn't believe him, but now I think there's a lot of worth in what he said at that time, because it is about understanding people's behaviors in investing. And so that's something to keep in mind moving forward. On that note, connected to that note of the contrast effect and comparing to other people, there's also the point of reductionism, the fourth point. You're taking someone else's performance in the markets and you're making an inference. The inference sounds something like, because this person is making more money, they are living a better life than me. Well, that's a terribly inaccurate way to understand life, and a certain pathway to building resentment and envy, which are not good things to have. That person might have poor relationships, poor health, or some other demon that they're wrestling with that they're not talking about, and you know nothing about. We all have our demons, me included. It's pointless to compare the quality of your life with some other person based on one arbitrary metric. And so don't stay rational. Now that we've gotten that out of the way, right? Like those are that falls into the category of, your own misconceptions. Well, think very clearly now about people that are actually doing well in investing, would you? Truth be told, though, there either aren't that many people that are actually beating the market consistently, or they aren't talking about it, which I believe the latter is the case. But if we do look at the titans of industry, people like Warren Buffett and Charlie Munger, and we observe their temperaments, we do get hints about the type of people that do well in the markets, right? They're probably long-term thinkers. That doesn't mean they don't make short-term trades, but they probably understand the economy and the markets from a long-term perspective. And they have an idea, they don't have knowledge, but they have an educated guess about where things are going in the long run. They're probably rational and self-aware. They probably don't let their emotions take over when they're in the markets, and they probably are self-aware enough to know where their domain of competence lies and where uncharted waters are. And so obviously we stay within our domain and we never enter the abyss in the unknown world of all the other types of investments. They probably have clear reasons and goals behind all of their decisions, right? Especially the first one. If you do not know why you are making a decision, if the reason why you're making a decision is not sound, it's not based on evidence and facts and knowledge and information, then you're in trouble. And they probably don't bite off more than what they can chew, right? They're probably never betting the farm like I did with Alibaba, because they never want to risk what they have to gain what they do not need. And they probably, on that note, refuse to go into debt or buy things on margin. Investing returns also probably isn't the only way that they want to earn their money. A lot of the time, maybe they rather earn their money with an income. And as their incomes increase, they increase the amount of money they put into the stock market instead of chasing 50% returns. And they probably understand taxes, so they probably favor capital gains over the long term over income, if that's what they want to do. But if you're someone that needs the income, then you also understand the tax implications of that. You've set up your portfolio portfolio in a way to be tax efficient. And that has to do with tax advantaged accounts, which we won't go into right now. They probably don't depend on the opinions of others to make their own investing decisions, especially if that other person isn't qualified to give an opinion. They probably don't listen to their uncle who got lucky with GameStop last time for investing advice. They probably know that anything that sounds too good to be true probably is. I mean, so many people get scammed because they get promised that their money will double every single month if they follow a certain strategy. And that's the definition of a Ponzi scheme if I've ever heard one. The point is, if you actually think about what it means to be a prudent investor, you can probably figure it out. And so what does this mean for you? Well, get educated, get responsible, take ownership over your own finances. But most importantly, look at reality objectively and make decisions that get consistent results in the right direction over time.